What's up, value investors? I've got Mark Jones here from Pragmatic Capital. We have a pretty interesting discussion lined up today talking about um, ad tech, social commerce, a bunch of fairly high profile stocks in these spaces. Mark is a longtime SumZero contributor. I think Mark's got at least a dozen ideas up on SumZero, has performed quite well. He's been ranked on numerous occasions across numerous categories, and I think is currently top 5 on the SumZero rankings list for performance. Mark, great to have you on SumZero. Would love to just start off by having you tell us a little bit about your background. You're obviously a passionate investor. How did you get into investing? And just tell us a little bit about Pragmatic, if you will.
Yeah. Well, first of all, thanks for having me. I'm really excited to be here. I love the SumZero platform. I think it's a great idea to, connect an industry that actually is really interconnected. But I think that this was a great way to bring it to the digital space. And, it's been, an immense value add, to what I'm doing at Pragmatic. And even the predecessor firm, I had a research business. I really appreciate what you and your team have done and the growth that you're having thus far. I'm so really excited to be here. So a little bit about me. Pittsburgh native. Went to Pitt, undergrad, grad, studied accounting, CPA. Went that whole path. I'm more of a recovering CPA. I knew I always wanted to go over into investing and kind of make decisions from the information. I love research and things of that nature. I've always been fascinated about business and completely, mystified by the stock market. And, eventually I did the MBA at Carnegie Mellon. And that was actually, a great kind of catalyst for me as becoming the type of investor that I am, and also becoming more entrepreneurial in my approach. In that I launched a hedge fund immediately after business school, more of a beta fund to employ this contrarian strategy that has really evolved up to date. And I also ran a research business where I was selling the research to hedge funds on the side. And then eventually, I put the fund in hibernation, focus on the research business, just get more of a track record. That's when I found SumZero. Get more of a track record, put more of the research out there. And then I got back to managing professionally in May of 2019, where I launched, Pragmatic Capital, 2.0, if you will. And we're an absolute return hedge fund, employing a hedge contrarian investment strategy. We conduct deep microeconomic research to construct a concentrated portfolio of about 12 or so individual stocks, primarily in the small and mid-cap space, that we believe are materially misunderstood with a relatively high expected ROI in about 12 to 18 months. And on the hedge side, we actually use derivatives to perfectly hedge our portfolio. And so that way we're able to have a net exposure of about 25%. And I'm really proud of how things have gone so far since launching. We returned over 130% to investors, which I think is pretty great, considering when you're contrarian, you're flying against the wind. When you're hedged, you're paying for that. That's expensive. And also, it was a global pandemic last year.
Right, that's incredible.
Background in Pragmatic Capital.
Did you start Pragmatic with your own capital? How did you fund the business?
Yeah. So I started Pragmatic Capital. I didn't have much of my own capital at the time. I only had 2 years of work experience professionally before the MBA. But what happened was I was able to develop a pretty good, brand, if you will, while I was in the MBA program at Carnegie Mellon in Pittsburgh, which is a tight-knit city. And I was able to get a name for myself for, the individual stocks that I picked. And I was able to raise, a few million to go ahead and put this, contrarian approach to work to see, is it as effective as I thought it was?
That's fantastic. So you're known, at least on SumZero, as being kind of very well. You've got this sort of bet on America, and you've really kind of reaped the rewards from having doubled down on the U.S. stock markets during the depths of the pandemic. What does betting on America mean to you, just philosophically?
Yeah. So if we rewind back to late February of 2020. Things were chugging along as normal. No signs of any looming threats really. And I was just employing my contrarian strategy, where I'm looking in the market for great investment opportunities that are contrarian. So while the market was up in 2018, 2019, so on and so forth, I'm looking for stocks that are down materially. So kind of out of orbit, if you will. And then when the pandemic at least started to hit the shores, if you will, just to watch daily what was happening in the market, just this collapse. And I'm watching it, and I was hedged, so I didn't even feel the pressure to sell, sell, sell. And I try my best not to ever follow the herd. Because I just have fundamental beliefs on, kind of this, I don't think that conventional wisdom is necessarily wisdom, and I want to get the data first. And what I found was, after a month of just selling, selling, selling indiscriminately, I took a step back and I said, you know what, this is a macro contrarian situation. I'm used to going against the wind, the tide on a micro level. But I found that, on a macro level, the same kind of story was playing out. And I thought, well, you know what, for this type of sell-off to, just persist, what that's really saying is that America's not going to make it out of the other side of this pandemic nearly as strong as it was. So, I kind of sat back and I said, okay, well, at this point, the market's down, 20% for the quarter, over 20% in a 1 month period. So, if I'm looking at just the amount of selling that happened, I would say, okay, well, I believe that while, COVID would be very difficult, I believe in our hospital system, that they would be stressed, but that they were robust enough to manage. I believe in American businesses that while they would be stressed, they would have the ability to adapt. I believe in, the average American citizen, that they would follow the respective, orders that were in place. And I believe in American, biotech, if you will, that eventually treatment and a vaccine would be developed, that America would come out on the other side. And so I believe that staying in the market in March of 2020 was essentially a bet on America, that there would be, a rebound. And I'm really glad to see that is transpired.
Right, and we saw the pandemic accelerate a lot of the trends that you're invested in as far as the digitization of various industries.
Right.
So let's get into some of the names. I think these are interesting case studies. One of your bets back in I guess early 2020 was Pinterest. Obviously, a well-known name, a platform with a lot of engagement, arguably under monetized. But just walk us through kind of your mindset when Pinterest stock started to fall, and kind of what convinced you at the time that not only is this going to rebound, but this is going to be one of the beneficiaries of some of this, some of the tectonic shifts that were happening in America at the time. Like what made you pull the trigger?
Yeah, you know what? I'll be honest with you. This was, once I accepted that the sell-off was happening, the market crash was happening, and kind of resetting and thinking about, okay, so I love economics first. Before finance and valuation, I love economics. I love commerce. I think it's kind of like the monetization of life. It's also this intersection with cognitive psychology, which is, personal hobby of mine to study. And I just sat back and I thought, okay, well, every industry is not disadvantaged because of stay-at-home orders or because of the pandemic. There has to be winners and losers. There's always, winners and losers, and oftentimes it can be a zero-sum game, if you will. So with that, I knew that there were opportunities out there for definitely, tech stocks that were much more insulated from the change to the physical economy, as far as people were not outside as much. But the difference between 2020 and 1912 is that we have the internet, and we have not only physical lives, we also have digital lives. And while the stay-at-home orders, or we can say the effects of the pandemic, were severely changing our physical lives, if you will, outside of the home, our digital lives were probably going to accelerate. And I was seeing data from the Verizons of the world, these telecom companies that were, starting to report that internet traffic was, of course, going through the roof during the stay-at-home orders, because what are people going to do, right? So I just thought, you know what? I know that there are companies out there that are going to be beneficiaries of this activity, because for some companies, this is an economic activity, actually. And so, I ran filters, and I wanted to see what tech stocks were high growth companies that were doing really well before the crash, that had a material sell-off. And I found two, but Pinterest is the first one. And once I saw that Pinterest stock was down 40 something percent in a month, I thought, wow, you have an opportunity to essentially have a contrarian, deep value, if you will, investment scenario with a high growth company. That's just that doesn't happen often. And I was already familiar with Pinterest. I'm a Pinterest user, avid Pinterest user actually, before the pandemic. So I'm really familiar with the platform. And what I found was that, you know what, so of course more internet traffic means that, they monetize that, right? Even though I found that they were under monetized, that's still a tailwind for the company. And while I thought that, and this was at least at the outset, as I did my research, start to materialize more, I thought, okay, sure, advertisers are going to shift their budgets and maybe even stop some, when the stay-at-home orders were being announced, because they didn't know what would happen next specifically. I believe that so you have cost per impression, then you have the amount of traffic that's on the site. Just this equation, I believe that temporarily you would have a compression of the price pay for the ads, but you would have so much more traffic during this time. And then as everyone kind of calmed down and readjusted their strategies, I believe that there was a long tail of growth for Pinterest, and that's what's happened.
What was the cell phone data that you were relying on, just to give you a sense of?
Verizon was releasing like white papers, if you will, during that time, and that's the primary one that I found. But I also like to use Statista. I think that they're a great aggregator of statistics from various industry sources across industries. So there are other kind of industry trade groups that would track IP traffic data. And then for specific sites, I actually use SimilarWeb and SEMrush, and they have a good approximation for web traffic data as far as the amount of web traffic just coming to the site on a month by month basis. And
So
those trends just were extremely positive.
You can check what Pinterest traffic looks like.
Yes.
Even on the mobile app, is that something?
Yeah. So it's an approximation, but it's the best proxy that you're going to have.
That's great.
And that just, again, just combined with logic, if you will, of saying,
Right.
seeing that people are at home, and I had the fundamental belief that people would just do more of what they were already doing in their spare time. And so that's the way that I kind of triangulated that Pinterest would be a beneficiary of these stay-at-home orders.
Sure,
And honestly, for me, it didn't take much extension of logic on that one. Some other ones are more difficult, but this was, I think, a layup, honestly.
So walk me through that. I think of Pinterest as somewhat emblematic of many of the high growth kind of somewhat recent IPOs where there's growth, there's a narrative, there's innovation, but the earnings profile is not exactly so great, right? I mean, the margin profiles are not something to write home about necessarily.
Yep.
So when you describe a business like that as high growth and yet deep value, what metric are you basing that conclusion on? Is it do you, especially with tech, because tech is notoriously unprofitable? How do you, are you looking like 5 years out to come to that conclusion, or what's sort of the valuation framework for Pinterest for you?
Yeah, so this is kind of the so our tagline at Pragmatic Capital is unconventional thinking, unconventional results. And this is one of the areas where we are unconventional. My approach to valuation is more of a relative approach in that I try to view the market as the price setter, because the market is the price setter. And I try to not I try to be as objective as I can about a fair value of this company, if you will. So I like to look at, well, what has the market shown a willingness to pay for this company in the past? And I'm going to get confidence from that, and also, not only willingness to pay, but what was the sentiment during that time? So if you had positive sentiment and you had even a price to sales multiple that was pretty consistent, over a period of time, I don't believe that ratios are kind of consistent by randomness. To me, that's the market showing that they're willing to pay this rate. And some market participants can think that's too high, but I don't really think that's material. I think it's about who are the participants in this particular auction for this particular stock, and have they shown a willingness to pay, a certain multiple. And when I found that, for Pinterest, obviously, if a stock goes down, 40 something percent, meanwhile, sales, I expect to actually increase. That's a significant collapse in the multiple that the market has shown a willingness to pay for this company. So for Pinterest, in my research for Pinterest, it was more of a price to sales ratio, not because I think that's, a holy grail or anything like that. It's just, obviously they were not profitable at the time. And the market has shown, kind of, if you were to average the price to sales since the company went public, you could see a trend. And so I just take confidence in that the market has shown that they're willing to pay this multiple, especially in a positive state. And if my forecast, which I also, forecast operations, are a really positive state, I believe that there's evidence that the market would at least pay up to this multiple, in the future when the tide changes, if that makes sense. That's
Sure.
our approach
Yeah.
for all
Yeah.
stocks.
Obviously, there's been a doubling, tripling. I don't even know how much the stock's gone up in the last year, but it's been a rocket ship.
Yeah.
You're still long Pinterest going forward. I mean, do you see it as kind of a long-term hold, or what's your kind of time horizon on owning a name like Pinterest?
Yeah. So I like to look at stock price movement as kind of a as symbolic of market expectations. And I always have a fundamental microeconomic point of view of the company. I forecast revenue, EBITDA, earnings per share, and I try to keep my forecast about a year out. So with that, as long as the company continues to, and there's a whole quantitative study I did to even get me on this contrarian path. But I believe that beating earnings results consistently is what's going to keep a stock in the trajectory that it's in. Now, the marginal return is definitely going to adjust. So, something may be growing at, Pinterest, I'm up about 400% on that name. I don't expect that going forward on a marginal basis. However, as long as the company continues to outperform expectations, I believe that that's significant reason for the stock to continue on this positive trajectory. So that's kind of high level, but specific to Pinterest, what I found is that, and even though I'm contrarian in my, I'm essentially betting on a correction, if you will, even a regression to the mean. There's some company that is misunderstood or mistreated, or maybe just what's going on in the market. People are not bifurcating between winners and losers. They just want to reduce their exposure, and they're being indiscriminate. I look at it and say, okay, I'm interested in great businesses that would be phenomenal for the long term. But for my investment objective, I want outsized returns. So, I wouldn't be in Pinterest for, 2 to 5 years like maybe some other individuals would be. Even though I think it's going to be a great investment, I would more so, get that significant ROI. And then once I start to see that the potential for outsized gains has started to wane, I would
Yeah.
move on to another one. And I can speak more about their business and what I love about it, if you're curious about that.
So, I mean, on the business itself, I think there's definitely a lot to be said about just the move towards social commerce, and Pinterest is obviously a leading name in that growth area. How do you see Pinterest stacking up against an Instagram, which is, I think, becoming, well, I mean, already is, sort of a freight train in the social commerce space. I mean, there's a ton of, maybe it's not quite pinning as what you see on Pinterest. Like, if you're shopping for, I don't know, wedding dresses, if you're a woman, right? Like, you might pin them on Pinterest, but you might also follow Diana von Furstenberg on Instagram. How do you see that playing out over time?
Yeah. So, I think that, and you alluded to this earlier, Pinterest is one of the most, I would say, the users on there are some of the most commercially engaged, as far as a lot of them are going to Pinterest for idea generation, with this high, I guess you can say, kind of a purchase intent, not necessarily on the Pinterest platform, but they are looking for some product or service to, we could say, commercially engage in. And so I think that Pinterest value add to advertisers is that historically, and they're starting to change this, is that on that customer journey, Pinterest is a frequent stop on that customer journey, and this is a great place to find them, kind of in a really brand safe environment where the advertisements look like pins, and now there are videos, there are stories. And businesses are starting to have their own profiles and having their own engagement, and you can, start to do more. You have more interactions with it, kind of making Pinterest much more shoppable. But I would bifurcate it into these users have a high purchase intent. They're not necessarily going on Pinterest to follow a celebrity or connect with their friends or message with their friends. It's kind of idea sharing, and actually a highly commercially engaged manner, which is highly valuable for advertisers. So I think that that's a sell that Pinterest has. In addition to that, Pinterest is starting to make the platform a lot more shoppable, to where historically, maybe 2 years ago, uh, there were a lot of great, images on there that were great recommendations, but it wasn't really shoppable. You couldn't really click on something and go to a trusted site. It would kind of be a site that you don't know where you're going. So clicking on Pinterest wasn't necessarily, the safest thing to do, because it could be just a dead end. But they've really cleaned that aspect up, and the amount of, click throughs on the platform have skyrocketed. That's what's driving their growth, and being able to shop directly from the platform is something that they're working on their kind of ad tech capabilities. And that's why they were under monetized, to what you alluded to, is that they were spending so much time developing the platform, which is great. But that's, I'm sure, as you know, separate from developing the capabilities to monetize the platform, from being an advertising publisher. Yeah. So that's my view on, Pinterest, their outlook. And I think that there's room for Instagram. There's room for Pinterest. There's room for all of them, because really they're taking a share from traditional and other areas of the digital space, but more so traditional areas.
You think this could be $100 billion market cap business in the next 3 years, maybe? Or if you were to put a sort of a target valuation on the business, I mean, what's achievable? Where do you think what do you think the bogey is?
Yeah, so I'm going to be really, really careful on that, because I think that I think that the market's willingness to pay, in part, and this gets to my philosophy of how the market works, which is pretty different than most individuals. I believe that it's really path dependent, and if things kind of if demand for Pinterest stock, if you will, kind of gets way ahead of what the company can even produce, that can make it a rocky road. But I will say this, from an operational perspective, where will the company be? I believe that they can multiply. Certainly their international ARPUs, if you will, and I definitely believe that they can get. There's reason to believe that they can also multiply at a lesser rate their domestic ARPUs, if you will, but it's on them. I really think that it's on them if they continue to develop the capabilities to give the advertisers what they want, because they don't just want a platform with a bunch of users. That's great. What they want is also a certain service side of the platform as well, to where you're giving them the ability to advertise in the way that they want to. So I believe that Pinterest can definitely start to see their monetization levels, significantly increase, closer to maybe the Twitter range. Not really. I wouldn't bet on the Facebook range at this point, because that's just a different beast. And there's been so much investment over time on that ad tech capability, and really making that kind of part of the business central. Whereas I think Pinterest is still pretty early in kind of fully accepting that they are an advertising company. But I think that the growth is it's definitely not a time to talk about waning growth, if you will.
So what's the delta in terms of ARPU between Twitter and Pinterest?
Multiple. So right now, just off the top of my head, I'm pretty sure that Twitter has 4 to 5 times higher ARPU than our Pinterest, and yeah.
And then Facebook would be like maybe 5x Twitter or something, or 10x Twitter.
Yeah. I think that Facebook, at least at the time that I was doing this, which I'm sure it's much higher, it was close to $50. So that's definitely the holy grail. As far as Pinterest, I just believe if you're an investor now, you still have so much of that runway, and as long as the company continues to give the market what it wants, which is growth. And also their operating leverage has gone through the roof. That's another wonderful thing about Pinterest that I wouldn't say no one's talking about, because if you look at the stock, you see how much it's up. You can see, they're not, unprofitable anymore from, an adjusted EBITDA perspective, just because of that leverage that's going to, happen.
Yeah.
But yeah.
Let's talk about Trade Desk. I know that's another name that you follow very closely. First of all, what is it? I mean, a lot of people aren't familiar with like programmatic ad buying, just how that marketplace works. But if you can just give a little background on their service, we can go from there.
Yeah. Trade Desk it's a phenomenal company. Honestly, it was a thrill learning about them, what they do, and how they are best in class at providing a product and service that we have all engaged with, but we don't know. There's a really high probability that when you're watching some connected TV, or you're streaming on Spotify or Pandora, or a podcast, or you're on a website, and you're watching videos on the website, and there are ads that are running. There's a really high probability that throughout your day you're being touched by the Trade Desk, if you will. And so which is I'm always fascinated by these companies that are integrated into life, but most of us wouldn't even know that they're there. Which I think that could be a sign of just how great they are at what they do. So what the Trade Desk is, they're known as a demand side platform. So essentially, fundamentally what they do is, so obviously there's just a whole universe of publishers, of content creators that sell advertising inventory, if you will, on their platforms, their websites, if you will. And there are also, as we know, a whole universe of advertisers, Procter and Gamble, and just every advertisement you see of companies that are interested in purchasing advertising inventory. So the content publishers, if you will, they're on the supply side, and the advertisers, as we know them, they're on the demand side. So what Trade Desk does is they service in the programmatic ad tech space, which is essentially using an algorithm to make purchase decisions of advertising inventory, rather than pre-established contracts. Well before that ad is shown, and kind of like you have commitments and things like that that are usually used in like the TV markets, newspapers and things of that nature. That's really underpinning the digital advertising space. Trade Desk is best in class at what they do in that area, because what they're able to do is they've developed an algorithm that essentially their valuation analysis, if you will, is superb. What they're able to do is say, hey, listen, we've got access to basically almost the whole internet that's not behind a paywall, if you will, and we have customers that represent some of the largest advertisers in the world. So they really connect, the universe of buyers and the universe of sellers, and that's a major reason that the universe of sellers wants to engage with the Trade Desk, because of all the buyers they have, and all the buyers that the Trade Desk has. They want to engage with the Trade Desk because they have this universe of sellers. And so what the Trade Desk is able to do is say, hey, listen, in 1/10 of a second, when advertising inventory becomes available, when you go to a website and the page is loading, what the Trade Desk is able to do is gather as much non-personally identifiable data on you as possible, to kind of get some demographic data about you, so that they can kind of value you as an individual and an audience of one, if you will, for their respective customers, which are the advertisers. And the reason that a company would pick the Trade Desk instead of another provider is that the Trade Desk is able to use their algorithms, which is their approach to valuing inventory, to say, hey, listen, we're willing to bid higher than what the market is willing to bid the other demand side platforms, because we know that for Mark, if we show this to Mark, there's a much higher likelihood that he's going to convert, versus to someone else. So we're willing to pay more because this is worth more to a provider of sport coats, if you will, versus if it was going to be Tide, laundry detergent. that's not as valuable for Mark, but it may be more valuable for someone else. So with that, the advertisers really like Trade Desk because of the ROI that they're able to get from going with Trade Desk. They're getting high value ad space, even though they're paying a little more. It's worth more.
Yeah. And what is Trade Desk take on those? Like, what's the split that they get?
Yeah, it's actually pretty attractive. It's well over 20%. So of all, so there's kind of like the platform spend, how much ever advertisers spend on Trade Desk platform, they get well over 20%, and that's been a pretty consistent rate. And so that's something that kind of incentivizes the Trade Desk to have more business, if you will, on their platform. So it's not as much performance based. It's more, which I'm inferring that if advertisers continue to go through Trade Desk and they're continuing to facilitate this growth and bringing more of their ad budget onto the Trade Desk, if you will, that's because they're realizing a high ROI.
Can you just help us understand who Trade Desk competes with? Obviously they're competing with some of the bigger names in the space, the Googles, the Facebooks, the Amazon, that have their own kind of internal advertising platform. But who else are they actually competing with?
Yeah. So it's actually a pretty diversified industry, if you will. There are about 7 to 8 other demand side platforms that are frequently cited in like the Gartner research reports on who are the best in class and things of that nature. And so you have actually Adobe has a pretty highly regarded demand side platform. Another organization by the name of Criteo. And I believe Media Math is another one. And so a lot of these players, they're really good at some aspects of the ad tech space, kind of like some verticals. And I have this in the research report, which users can go on SumZero and check out, but kind of see where the Trade Desk stacks up against their competitors across the verticals in the ad tech space. And majority of them, Trade Desk is either number 1 or number 2. But as far as just the overall, where do they weight across the board, Trade Desk is number 1. So and what that really captures is a lot of advertisers approach advertising in a campaign format. So they design the campaigns, they build the campaigns, they adjust the strategy depending on the results that they get, which is an advantage of advertising in the digital space. You have real-time data and you can adjust in real time. And so, the Trade Desk is, top ranked in the media, the campaign planning, launching campaigns, adjusting campaigns. But yeah, so those are the competitors, and Trade Desk is definitely, best in class. Based on what the industry experts have reported, and using Trade Desk's results as a proxy for their effectiveness, I think that supports Trade Desk as like a best in class organization.
And just quickly on evaluation, from a valuation standpoint, how do you value this business? Like, do you have a target price?
Yeah. So so I found Trade Desk when so the stock was very similar to Pinterest. It was very eerie how so many of these stocks have went down in the 40% range from where they were at before. And they got to that point prior to the crash because the market really responded well to their operational performance and the growth trajectory. So here we are, similar situation as Pinterest, where the stock basically collapses, and you're able to get in at price levels that were where the business was at in 2018, maybe even 2017, even though their prospects are even greater than they were, in January of 2020. So I got in I got into the Trade Desk at about 144 a share, and my price target was around $300 and something per share. They shot well past that, got up to 900 or so. And they've since, pulled back for other reasons which I can speak of with the whole tech space, inflation and things like that. And I have views on that. But the company's still doing great. So I value the Trade Desk. Again, so I try to get as many valuation metrics as I can, and I do kind of this statistical analysis to see basically, is there a pattern? Has the market shown, or excuse me, a trend? Has the market shown a willingness to pay a certain multiple? I'm indifferent if it's PE, if it's EV, EBITDA, if it's price to sales, as long as I can see this clustering around a certain level, that to me is very meaningful because I don't think that's an accident. And so with the trade desk, I actually use EV to EBITDA because the company was actually profitable already, and now they're much more profitable. And so I was able to, you know, see some consistency in that EV to EBITDA multiple. And so what I do is I have my forecast for operations, and then I kind of stack that up against Wall Street's. And you know, we're really effective at that when it comes time to earnings calls. And then so I take my forecasted EBITDA, and then I say, okay, well, what's the average EV to EBITDA multiple in, you know, good times, because I believe that the market is going to see good times are coming. Then I'll give it a haircut. I'll say, okay, if I reduce that by 20% or 30%, what would the price target be? And if it's a materially higher level than now, that is the type of scenario I want to be in.
And right now, do you have a strong view on trade desk as far as where it could go?
Yeah. So, you know, again, you know, similar to, you know, Pinterest and all of my names, you know, it's always path dependent, and it's always just dependent on the trajectory of the business. You know, I'm really a microeconomist, if you will. I start from there and I build everything up from that point. I believe that this company is still in early innings from a revenue growth, definitely from a profitability perspective, because they're starting to get that operating leverage. They're still developing their international business, which is not as developed as their domestic business. And in the domestic business, there are core trends that the company is a beneficiary of. The trade desk is just the great beneficiary, you know, and I think that's why Jeff White started the company, because, you know, this was, you know, he kind of positioned himself to be in a prime position for these trends of the adoption of digital, kind of like the digitization of the advertising industry. So as long as that trend continues to happen, which that's accelerated because of COVID, additionally, they're in these high growth spaces. Connected TV is a major, you know, kind of inventory segment they're in. Audio, video, just the highest growth areas, mobile. So as long as those industry tailwinds continue to persist, Trade Desk has shown that they have an effective strategy to grow share at more than twice the market. You know, I believe that the stock will continue to be rewarded for this execution. So, you know, I'm still long. I definitely believe it can still, you know, appreciate based on, you know, what the market has shown a willingness to pay from an EV to EBITDA perspective and our forecast for EBITDA, that I think that there's still at least, it can at least regress back to where it was at, which was the $900 range by year end. And it's already starting to get there now. The market has had more of a green light for the tech sector.
Yeah, you mentioned inflation. It's an interesting segue. You know, I remember when you know, well, certainly when Biden came to office, this became even more of a discussion point, as some of the stimulus numbers being tossed around were, you know, a few trillion here, a few trillion there. People are like, where's all this money going? You had stories about people spending stimulus checks on Bitcoin and whatnot. You know, so tech, and especially the higher multiple stuff, definitely got hit pretty hard.
Oh, yeah.
And interestingly, the FANG names were like the defensive plays, right? And actually they really didn't get hit hard, and actually many of them are now at all-time highs. What are some of the names that, because of headline risk around inflation, you've seen not only get you know, not only feel a lot of pressure, but are also kind of the most interesting comeback stories due to this macro event, you know, which really, you know, for a lot of these businesses, you know, you take a trade desk, for example, like whether there's inflation or not, people are still going to want to, you know, advertisers are still going to want to place ads and do so in a targeted way. But I'm just wondering, is there a name that you feel was not only unfairly hit, but even in you know, even with the specter of inflation, we'll be able to pass pricing on to customers so that they won't actually really feel the pain?
Yeah. So definitely the stocks that were the most hit were actually the two that I just talked about, Pinterest and the Trade Desk, in part because, you know, the immense growth that they had, and, you know, it's just really difficult to disconnect your individual investments from macro themes right now. We're still not in a normalized environment, and I think that as a stock picker, you have to accept that and just think about, well, what are the economics of these macro events, if you will? How will they trickle down to, your particular industry? And because things are so pervasive right now, I think it's a lot easier to see that effect versus if it was more kind of just cyclical economics driving the macro thing. That's a lot more, I think, removed from the individual level. So I would say that, Pinterest and Trade Desk are definitely ones that took, material hits during, the sell-off in February, and just has persisted through. And even after they had phenomenal earnings calls, this most recent earnings season, major sell-off ensued. And I wasn't surprised by that. We have a hedge strategy, so we're not necessarily going along for that same ride, and we're actually able to capitalize on that volatility, because that's exactly what I think it is. It's volatility. I never believed that inflation would materialize in the way that I guess the market, I wouldn't even say expected. I would just say kind of like is like implied, because I think that, and this is again based on our philosophy of how the market works, I actually don't think that many market participants are doing homework, if you will. I think that it's more risk on, risk off. It's more portfolio management, top down level of, hey, this sector isn't working right now, let's move to this one, and not necessarily a fundamental view on what's happening. And once kind of the dust has settled and it's like, oh, it's safe to go back, it's a pendulum. And that's what I did in 2020, and that's what I do just in general. So, and I believe
what's your, just curious on your hedging strategy. I'm sure it's stock specific to some degree, but how do you, especially with tech, which is so volatile, and you saw this with kind of the rotation out of tech, this last quarter. Do you have a favorite strategy? Is it buying puts on the NASDAQ? Is it a pair trade, or what do you often do from a hedging standpoint?
Yeah. So I often say,
or is it just not selling and waiting?
Right. I often say that a lot of market participants actually have what I believe is kind of a white label approach, where it's this kind of investing manual that was kind of passed down to them. And they, they have a portfolio that's incrementally different than the other investor with that same manual, if you will. Maybe they're underweight, overweight, the same stock that the next person is in, underweight, overweight, probably got in similar times, things like that. But I think that many of these market participants are not structurally different. So I say that there's this, white label approach that a lot of market participants have, and they are the ones that ultimately determine the price because they're so large. It's kind of clustered. If you do a weighted average, there are more of them than the contrarians, if you will, who have a different approach. And I say that Pragmatic Capital has more of a white glove approach. So it's very, very, curated, and that's why we can be concentrated, if you will, because we know what we're looking for, and we know that the diversification comes from the different economic scenarios, not necessarily having a portfolio of 50 stocks, if you will. So from a hedging perspective, the best example to just say is, let's say that, we purchase, 1,500 shares of Pinterest. We would purchase 15 contracts, 1,500 shares of puts on Pinterest, typically about 10% or so out of the money. And actually the implied volatility, which, causes the expensiveness to be affected, is actually pretty low for a lot of these stocks. So you're able to do it in a really cheap manner, so long as you get a return on the upside. And what that does is, if there's this like material movement, we're perfectly hedged, so that it like the net effects look much different than the gross effects on the downside. But on the upside, when a stock just materially booms, those kind of it's kind of like a rocket ship where once it gets to a certain point, you just have certain parts that just fall off and it doesn't affect the orbit. So that's how we approach hedging. We may have more hedges if I think that we're kind of going into a if I think that the market is going into this like contraction state. If the market's like a cell, it kind of goes into this contraction state versus expansion state, and it can be temporary. It can be around big events, inflation data or whatever. It's not a big deal at all just to be over hedged, if you will, especially if it's cheap. So yeah, and that was a godsend during the market crash.
Do you outright short as well, just by borrowing shares?
I do, yeah, I do. And then that hedge is a call option. When we go short, we would have call options to perfectly hedge that, really just to create that asymmetric risk reward, to really deal with that single stock risk. And that's how we're able to keep the net exposure really, really, really low. And we're able to do that because, we only pursue high expected return investments. We're not looking at, you know, kind of reasonable growth, if you will. We're looking for situations of immense dislocation, so that we can get the highest potential ROI for the research we're doing and going against the herd. If you go against the herd, you want to be rewarded for that.
So if you were to
Yeah.
quantify your return threshold or your cost of capital, what would that be? Are you looking for 100% return over a 12-month period? Or what's sort of the
I think
watermark?
that if I believe that this investment can easily increase 50% and the market wouldn't bat an eye, then that looks interesting. I definitely would prefer, more. And how I approach it is this. Well, let's say a stock was at $100 a share and it went down 60, 70% over a 1 year period, or 40% in a 1 month period. But let's just stick with the $100 a share. Let's say it went down to, $30 a share or $40 a share. Which is our typical stock. That's how we find it. It's kind of like there's blood in the water, if you will. And
right.
You see, okay, it went down to 40. If it goes back up to 80, the stock is still underwater from that relative price, but we've doubled our money. And so, the market's not necessarily in this, there's already been this huge run up kind of behavioral, finance approach. So yeah, it works wonders.
Did you buy Facebook during the Cambridge Analytica scandal?
No,
exactly
I didn't. I didn't. I was looking at it, but I didn't.
So, just to end, I want you to give us the scoop on Funko. I know it's a favorite of yours. So
yes,
you can tell everyone what that is and what the product is and how you think about it.
Funko is a really, really, really interesting company, and I encourage everyone to at least just go out there and just learn a little bit about Funko, because their customers are the best customers you could possibly want. These people are so engaged with the brand. The CEO is so engaged with the customers. It's kind of like, monetizing the Comic-Con crowd, if you will, and beyond. So Funko, they're known for these products called Funko Pops, and I'm sure we've all seen them. They're like the modern day bobbleheads. They're like vinyl figurines, about 6 inches, and let's say 4 inches. It's the head, and it's in this whimsical manner, right? And what they do is essentially, the Funko Pop is just kind of like a form factor. It's a canvas, if you will. The reason that people purchase pops is because of the license image, the likeness that's on the Funko Pop. Usually it captures some nostalgic brand for you, maybe Pokemon, maybe Harry Potter, maybe Back to the Future. It just ranges, Freddy Krueger. It just ranges up to, current, athletes and things like that. And the image kind of captures, as far as the facial expression, captures their likeness. And it's really, 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 it kind of has this like emotional attachment to it. And what their consumers do is they build collections. It's kind of like, once you pop, you can't stop, because, you don't just buy one Funko Pop. They're only $10, so you find that people have whole collections. And there's a documentary on Funko actually where they meet up for conferences, and some people have actually met their spouses at Funko conferences and things like that. And while the market seemed to think that Funko was a toy company and the average customer was, a 10-year-old child, actually the average customer is about 34, and about 51 or 52% of their customers are female, right? So it's a really interesting company. Found them when I found that whole retail space did not participate in the market recovery through Q4 of 2020. So once it became August of 2020, we were looking for more opportunities of companies that were, so the technology were, the companies that were actually beneficiaries of what happened, and they have a long-term win. But the retail name was, okay, where are the epicenter stocks at? These companies that were greatly affected, but it was short-term, it was short-lived, and they actually made changes in the storm to come out stronger. And we identified several. Funko was one. We got it at about $5.50. Right now, it's at about $25 a share, and it's been less than a year. It was really great timing. And what you found is that the company did not stop innovating just because COVID happened. And this is a benefit that a lot of retailers actually have, the ones that still make it, is that they were able to significantly reduce their overhead, because a lot of them found that they were bloated organizations and they could be much more lean. And that's what the pandemic showed a lot of these companies, is that you can do more with less. And so what happens is that operating leverage, if you have revenues that just normalize, EPS is going to multiply because of that operating leverage. And that's what's been happening with Funko. And they're getting into the NFT space, which I think bodes really well for their collectibles approach. So yeah, great company, great CEO, great management, diehard fans.
What's the metric that you look at for them? Like what's sort of the is it the price to sales?
Funko had a pretty consistent EV to EBITDA ratio during, kind of like, good times, if you will, versus, when, sentiment was negative, you would see that multiple compress. But I believe that, based on our forecast that, Funko would have a phenomenal, 2021, where they wouldn't just rebound from 2020. They would accelerate from 2019 levels, and earnings per share would actually be a multiple. So with that, same thing with EBITDA as well. So that's the multiple that I use for Funko. And again, as you'll see, the methodology is identical for all of the investments that we make. It's more so, the market is who we are going to be selling our shares to. So we need to know, what does the market care about given certain states? Our job is to predict certain states, but we just look and say, okay, what will the market pay in this state that we're predicting? And so we're not price setters. Of course, we have to live with the market price. And so what I'll do is I look at the, trends that the market has been willing to pay for this stock in certain conditions, and I have a high degree of confidence in that, and it works like a charm.
So like, just to go back to 2019, what was the EV to EBITDA multiple back then? Just
off the top of my head, I couldn't tell you, simply, because, this research was probably done in August. I would say it was around 10, but, I wouldn't want to, go on and say it was this and it was really that. I've got, I do know that it's more about the relative EV to EBITDA level, as far as what I'm gonna, burn into my memory, if you will, not necessarily what was it in absolute terms. It's more relative to where it usually is at. Where is it at now, if that makes sense?
Is it still, I mean, by now I'm assuming it's above what it was in 2019, just given how the stock's run up.
Well, it's actually not, because the EBITDA has multiplied.
Wow.
So yeah, so it's still in a range where I think it can actually expand beyond those 2019 levels, because their growth outlook is actually much stronger. And it was strong in 2019, but there were some headwinds that the company was facing. So I think that, and also they have another, and this is why it would be good for listeners to look at the research on SumZero. There are other growth drivers that the company has that actually fundamentally transform the company as far as a growth perspective. They're starting to sell other form factors. Loungefly is a brand that they have that sells like book bags and other, apparel items that have that likeness of the pop figures. And that business did phenomenally well during COVID, and growth is only increasing. Not only that, but their direct to consumer business, which, was really nascent pre-COVID, is now a material portion. So, and they have a lot higher margins on that. So the company is actually fundamentally different now going in. And just from, just to take it a step back, the consistency and approaches, what we like to see is, for the companies we invest in, does the industry have, strong tailwinds? Because we don't want a company that's kind of swimming against the tide, a declining or a stagnant industry. It's really hard to grow there. Great industry trends, a great core business that still has potential, but we also like to see situations where there is another line of business, if you will, that was nascent, but that's growing. So those typically our three thesis points are going to consistently be around that.
Got it. This is great. Mark, I'm just curious, before we let you go, your entire fund is predicated on contrarian thinking and really diving into sectors that have been underperforming for a variety of reasons. Just in terms of your own personality, like, were you yourself a contrarian thinker in other aspects as well growing up? Like, I'm just curious how you landed on this particular style of investing, and maybe how it's reflected in other parts of your life.
Yeah, so I'm going to get a little philosophical here. I believe that everything that we do is really a manifestation of our psychology. Like I said, I love psychology, cognitive psychology, things like that. And so, I found this path because I was attracted to it, really because it's how I naturally think anyway. From this like accounting approach, which is more objective, verification, just black and white, and then this like data approach, which I'm really thankful for my experience at Carnegie Mellon, because it's just really a data-driven environment, and it's more a way of thinking. It's not just like a skill set. It's more of a mindset, and extracting meaning from data, and not allowing others' behavior to influence your behavior. Allow the merits of the situation, the logic of the situation, to determine the decisions that you make. And I'm a first generation college graduate. No one from my immediate extended, I didn't know anyone who graduated from college, any college, at all. But I love business, and I just wanted to learn more. I had so many questions about, from the time I was a boy, what is this? Why are these chips 25 cents and not 35 cents and not 27 cents? Questions. There was just so many questions. And then as I've grown older, it's like, okay, well, how about I go into those questions, since no one could really give me those answers? And that's how I found this. And this is why it kind of fits like a glove, that white glove approach,
Awesome. That's great to hear, and congratulations on all your success, Mark. We'll have to be in touch, and I'll be following Trade Desk and Pinterest and Funko.
Yes.
I'm gonna have to check out those bobbleheads. Maybe for my kid, she'll probably enjoy it.
You might grab a couple yourself, and then before you know it, you may have 20 or 30. It's I got 2, and then I've got 20 now. So it kind of, you just add this. Oh, you've got Kevin from Home Alone. Oh, why not the mother? Oh, why not this? And it just kind of adds up. So yeah, and I will be posting Peloton on the platform as well. That's another contrarian name.
You know what? That I'd love. I have a lot of personal views on that one. And my wife bought a Peloton.
Yeah.
Actually, right around the pandemic, maybe a little bit before. But it's a very interesting name, and I'll be looking out for that.
It'll come in the next couple of weeks. A really transformational company that some may say, well, that's not contrary. And look how much it's up. I'll definitely show people why it is contrary.
Awesome. Appreciate it, Mark. We will certainly be in touch. And thanks again for chatting with us.
Awesome. Great. I enjoyed it. Have a great one.
Take care.